Good evening, everyone. My name is Robin, and I will be hosting this webinar with Rickard Nilsson from Autostock, who will present two powerful and back-tested trading strategies. Before Rickard comes on, I want to take the time to mention our trading channel, Nordic Traders. This is a Telegram group where you get our trading signals directly to your cell phone. If you're a Swede, you go to Daytrader.dk. If you're from Norway, you go to Daytrader.no, and if you're in Denmark, you go to Daytrader.dk. The sites pretty much look the same, and you can find the site to the channel on this banner. So you click here, and you come to this site where you can read more about the channel. You can see the performance of some of the strategies we use, and you can read a lot about other stuff also about the strategies and about us. If you want to become a member, you just click one of these green buttons and you come into the Telegram channel. If you don't have the Telegram app, you will be prompted to download it before, and then you will get access to the channel. First, you come to the trial channel, and if you want to become a VIP member, you must have an active account with our partner broker, markets.com. And when you are a VIP member, you get access to more under channels and more signals and so on. So if you're not a member, you can become one on this site. And enough about that. Now I want to say welcome to Rickard Nilsson. Rickard, are you there?
Hello, yes, good evening and welcome to this webinar where I will walk you through two simple but effective trading strategies. I am the CEO of Autostock in Sweden, and we have exclusive cooperation with Nordnet since lots of years back. So you may have been in contact with us at some point, or if you are new to this, you will get some information links at the end of this presentation. Okay, let's go through today's schedule. We are looking at two different trading strategies. It's the CODA and the bar light strategy. Both are very simple but effective trading strategies, and both are also multi-asset strategies. So I will walk you through those in a moment. And also we will look at the effects of diversifying trading these two strategies or several more strategies at the same time. What does effects that gives to your portfolio and the performance. So we will start with the CODA strategy, which is a weekly cycle strategy for suitable for stock indices. This one is actually quite an old strategy with us. We developed and published the first version of this at least 10 years ago. It's based on the weekly cycle, closely related to the more common turnaround Tuesday strategy, which some of you may be familiar with. And one of the key features of this strategy is it's simple to understand. The trading rules are quite easy to keep in mind. So this one is possible to trade manually, of course, but you can also trade it automatically, which I will show you later on. We use this one in a swing trading time horizon. So we use daily price bars for the analysis. And it's included as one of the free trading strategies in the basic AutoTrader package. So the analysis looks like this. We have daily bar chart from the OMX index, stock market. And what we can see in the lower part of this chart is the blue graph, which shows the statistical probability of a higher price the next day. So this is basically the outcome of the last 1,000 trading days, and we have simulated the price movement for each Monday, each Tuesday, Wednesday, and so on. And the outcome is presented as a percentile figure to the right in this chart. So what we can see is that, let me just go to the next slide. It seems that Mondays and Tuesdays present a slightly higher probability of a higher price the next day. And the lowest probability for higher price the next day is found on Wednesdays, which are marked here. It's not a huge difference. It's from 47% probability up to about 57 at the best. These figures move from time to time also, and this is the last 1,000 trading days, which is about 4 years. So if you go back 10 years in time, it might look a bit different, but the statistical edge has been proved to be reliable from decades back in time, so which I will show you. So we can use this. It's a slight tilt in the edge of entering the market on a Monday or a Tuesday. So the simple test we can begin with at this point is we enter a trade on Monday and exit on Wednesday. And the rules are we enter at 10 minutes before closing and we exit at 10 minutes before closing. So we use daily bars but intraday resolution data for this analysis, which means we get a pretty accurate price from the market, not an official closing price, which you can basically never trade at. We prefer to use the price at 10 minutes before closing because we still have a relevant price for the stocks, and well, the market is still open before the closing call. So and this simulation is done on the OMX index, as you can see. We end up with 0.13% average profit per trade. We have done 505 trades during this time. It's from 2012 until the last of August this year. And what you can see is the performance is not very good the first 2/3 of this time, but right in before the Corona crash in the market, volatility rises, and for some reason performance increases dramatically for this simple edge. So what that tells us is we can always speculate, but I prefer to work with simulations and try to understand what we can do to improve our edge. And the next step is to try to find some additional rules to improve this strategy. It's simply not good enough to trade at this point. So an example, we can add a rule that says daily low is lower than the 2 previous days, which is basically we are looking for a small dip in the market, which to present a better opportunity to entering a long trade at a cheaper price. Also, we found during the development process that we can increase the performance if the close price is below moving average, 20 days moving average, which is kind of strange because this is a long only strategy, and usually they perform better above moving average, but this one is the opposite. So, and what happens if we do a simulation of this one with the additional rules? Well, you can see for yourself the average profit per trade increases to 0.22% per trade. On the other hand, the number of trades is greatly reduced, almost cut in half. But this is actually an advantage because we have filtered out the bad trades to a great extent, and also the performance looks much more stable. It's not very good at the beginning, but this second and third part are much better. So this is a step forward, and we can continue to look for more rules to improve this further. And up to now, we have just used Mondays as the entry condition. We can add also Tuesdays. And the rule we come up with is that today's low has to be lower than the three previous lows. So we're looking for a bigger dip in the market to push the price even further down. This adds more opportunities now that we have 2 days of entry rules. And it ends up with roughly the same profit. So 0.22% per trade, but we have slightly more trades, 293. So this increases our total gain, but still the performance at the first part is not optimal. So we have to try to find another set of rules to increase this. And because this is such a simple entry strategy, we can leave it at that and try to play around with the exit conditions. So the only exit conditions we have used until now is that it's Wednesday and we are 10 minutes before closing time. We can also add a rule for exiting if the price is higher than yesterday's high, which means if we enter at a Monday, for example, if the price is higher on the Tuesday, we can exit already, not wait until Wednesday. So this also means that no trade with this strategy is longer than 2 days. The only exception to that is if Wednesday is market is closed for some reason, it's a holiday or something. But then we exit on Thursday. So what happens with this addition to the exit rule? Well, you can see the result here. And now we are looking at a slightly more stable equity curve. The average profit is increased to 0.27%, which is actually quite okay for this simple strategy. It's fully tradable, no problem at all. So this is almost a ready strategy to trade. And to check it out, we always use to verify the strategy. We use out of sample data. We have this is now done for 2012 until now, which is a good 10 years. But we want to verify our strategy and use data from 2003 until now. And remember, this is still minute by minute resolution data to enable us to enter and exit the markets 10 minutes before closing time. So the final conditions: enter long is it's Monday and low is lower than the 2 previous lows, or close is below moving average 20-day. Or you have a Tuesday and today's low is lower than the 3 previous lows. And for both these entry conditions, the time should be 10 minutes before closing. To exit the long position, we have basically 3 different exit conditions. The first one is close is higher than yesterday's high, or it's Wednesday, or you have a stop loss exit at 2 times the average true range the last 20 days. This doesn't affect the performance very much. It only strikes a few times during this long period of time, so it's not essential in any way, but we have added it just as an additional safety precaution. And for all these conditions, the time has to be 10 minutes before closing, just like the entry. So what happens if we try our strategy for a longer simulation, 2003 up until now? You can see here it holds together quite well, actually. You can see the financial crisis here, where the index dropped about almost 70%. This strategy is almost unaffected, which is largely because the time in market is very low. And also it handles the 2015 decline in the market reasonably well. This is a long only strategy, so it's hard to make money in a severe decline in the market using only this, but actually it happens during the Corona crisis. We end up with a positive performance, even though this was a very dramatic move in the market. It only lasted for, I don't remember, 17 or 18 stock trading days, but it was at least 30% down for this index, so quite a dramatic event. Also, the last few months we have a positive performance, even though index is down almost 30% as well. And we have more ways to verify that this statistical edge is valid and it works, to prove the robustness, if you like, and that is to trade other indexes, for example, German DAX. And this is what it looks like. In this case, we only have sampled intraday history from 2005 up to now. But still, it clearly shows quite okay performance. The average profit per trade is 0.26%. And some other interesting statistics as well is that we have 317 profitable trades, but just 202 with losses. So that's more profitable trades than losses. And the accumulated profit amount of money is considerably higher than the compounded losses, which is also a good way to check a strategy's robustness, in my opinion at least. We can try some other indexes as well. We have the Dow Jones with data history from 2007. You see a similar equity curve. We lose some money during the financial crisis here, but not very much actually. It's quite reasonable still. Also, it handles the Corona dip reasonably well, and also the last few months with a very strange decline in the market actually, with a kind of a low volatility bear market, which is extremely unusual. So it keeps up quite well. And finally, I have also tried on the Nasdaq 100, which is basically an index which almost never drops, except maybe this year. So it's not a surprise that the equity curve looks quite okay for this index as well. The average profit per trade is higher, 0.38%, and which is probably the result of we not having history data earlier than 2012, sorry, which means we are not in the financial crisis part of this history. That probably cost some money, but we could try to do a simulation on daily bars It will not be as accurate as this one, but it's possible to do just to check out the performance during that part. I have not had the time to do that yet, but we can try to do that in a few weeks. So it looks promising, and the conclusions is that the strategy seems to be robust. It works with several stock indices, and it yields a relatively high average profit per trade. And here is the combined simulation with all 4 indices, including slippage, which is derived from the spread of the mini futures we use in trading these strategies from Nordnet market. So the equity curve is pretty nice. It's not suffering much from large market movements, down declines. It picks up quickly after any sign of a bear market. So it's kind of a simple strategy. Do we have any questions about the Coda strategy before we move on to the Barlight strategy?
No, the only question was if it works on other indices, but you answered that one. So go ahead.
Yeah, basically, I think you can try this strategy at several more stock indices, like if you have London or Paris or some other markets you want to try this. I think there is a substantial statistical edge to this set of trading rules. You can, if you code this in another platform and try it on other markets, it's not very difficult.
We have also a question if it works on S&P 500.
Yes, sure it does.
Yeah.
Yes, it does. Yep, I will move on to the next strategy, which is called Barlight, and this is it's a multi-asset momentum strategy, which it's derived from one of our educational lessons in the Infinity education, which we are running this year on our end, and this is one of the edges in a larger multi-edge strategy pack we are developing. So this one turned out to work on several assets, not just stock indices, which makes it interesting in a bear market in bear market times. And the name is kind of a we played around with the words, and price bars colors is what determines the trend in this edge. And and similar to the Coda strategy, this one is equally simple to understand. It also uses swing trading time horizon, maybe slightly longer. Well, I will walk you through the trading rules. This one is quite simple. You need to count the color of green bars and red bars during the 7 last trading days. And to go long, you have to meet the following conditions. Today's low has to be lower than the 4 previous trading days low, which you can see at the yellow entry dot here. So this bar's lower than 1, 2, 3, 4. And then we enter long if the number of green bars is larger than the number of red bars the previous 7 days, I should say. So here you have 1, 2, 3 red bars, but you have 1, 2, 3, 4 green bars. So we have what we define as trend upward, even if there is a slight dip in the market, which present a good entry point. So we go long at this point. Also, all signals for any equity this one is connected to is released at 4 p.m. until 5 p.m. So that's a trading time window we use. And this is not actually critical in any way, but it was a suitable time for most stock indexes and also other equities as gold, Brent oil, some currencies, or whatever you might find useful. So and the exit signal is triggered when these conditions are met. We have two exit rules. The first one, if today's close is higher than the previous 10 days high, which happened here. You can see the blue dot, and this price bar is higher than the previous 10 bars. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So not even a question. We go exit here. The other rule is if the number of green bars is lower than the number of red bars over the last 7 days, at the same time as close is higher than yesterday's high, which basically happens here and here. So we just reached higher than the previous day's high, and the number of red bars is larger than the number of green bars during the 7 last days. Then we go exit, and that's it basically. All signals at 4 p.m. to 5 p.m. This one is for Brent oil, but it looks similar whatever equity you choose to trade with this strategy. I haven't actually simulated all of them, but we had tried with Brent oil. We have several currency pairs. We have gold, we have silver, we have some stock indices. Also, I'm trying to check out individual stocks as well to see if this edge is good enough to trade stocks right at the price, but not finished with that. Maybe we need to adjust something, but for those equities it works fine. So for example, you can see for the dollar, Japanese yen, you see the trading signals here. Yellow is entry long, blue is exit long. No short positions with this one either. So most of the trades end up with a profit. This one did not, but the next one did, the next one did, and so on. The equity graph you see here is not just for dollar yen, it's for the entire portfolio of several assets. So you can see it builds equity during this period of time. Just looking at individual signals here. So Japanese yen, fine, and you have gold. A few trades also. The first one actually did end up with a small loss. The next one went home with a profit, and the next one, and the next one. So you can see the theory in how the signals play out. And S&P 500, no problem here. You see a few trades. Remember, each bar these are daily bars. So there might be a few days between trades for an individual equity, but altogether, if you trade 6 or 7 or 8 different equities, you end up with signals more or less every day or every other day. So it's quite an active strategy if you connect it to a few equities. Here is the Stockholm market. It's a kind of a volatile and very busy market at times. It's sometimes unpredictable. So you need to apply a price action based strategy to handle the Stockholm market many times. and so on. So there are a few more we can choose, but you understand the principle, I guess. And here you can see a more a larger simulation using all these 8 equities altogether. And it looks like the blue equity curve here. We use the leverage is, I think it was 0.5 times the account for each equity. And because not all of them are in the market at the same time, you can get away with this. Sometimes you end up with a leverage larger than 1, of course, but I guess that's you're no strangers to using some kind of leverage if you are active traders. And slippage is included in the simulation according to the Nordnet market mini futures, which we normally use for trading this. If you code this strategy in some other platform, you might use CFDs or whatever instruments you prefer. Nothing needs to be mini futures if you don't are used to them or something like that. So what about the numbers? Yes, we have about average profit per trade, all assets included, is 0.63% on average, which is quite high. And that's a result of the swing perspective horizon. So a trade is usually in the market for a few days before exiting, which allows for a higher average profit per trade. Also, the leverage per asset is defined by volatility. So I will walk you through that calculation also. It's nothing you need to do actually. You can use fixed leverage for entering the market, but we use, in this case, a volatility-based leverage, and it's calculated as 100 days average true range divided by 20-day average true range. And the nominal leverage is set to 0.5. And the final leverage is volatility. You subtract 0.25 and multiply by the nominal leverage. So the actual leverage per asset moves between 0.25 and 0.5, depending on the market volatility. So in high volatility trading times, you get a lower leverage, which is logical because you might not want to take that kind of risk that you're willing to take in a low volatility stable market. So that's one way to benefit from a low volatility market, is to increase the leverage, which is done automatically by this one. So it's a neat little trick you can use for if you design your own trading strategies, for example. You can try out this one. Okay, so are there any other questions about the Barlight strategy before I move on to show the effects?
Yes, Sten is wondering if the Barlight strategy works on intraday timeframes.
Not sure actually. I haven't tried that. Possibly it can do that, but it's not something I have verified. But I can check that out. It's not very difficult. We can try to do a simulation of that.
Yeah.
So if Sten wants to get in touch with us, we can check out how this performs.
Yeah, it would be interesting to hear. I bet
Yeah,
there are a lot of
of
day
course.
traders here that
I understand.
like,
Yeah,
yeah,
everybody wants to have a small time frame.
yeah.
That's the very common um, demand for that. But at the same time, I can also tell everybody that it's much easier to make money using daily bars than 30 minutes bars or 5 minutes bar or whatever. It greatly reduce the market noise, and you can see the trends much easier using a lower resolution, actually.
Okay, so pretty much all your strategies they perform best on the daily.
Not all of them, but most of them, I would say.
Yeah.
Yes. But this doesn't stop signals from triggering any time during the day. Some strategies have no time window for triggering signals. So if whenever a condition is met during the day, you might get a signal. So not all of them are trading at the end of trading days, but it can happen any time during the day.
Okay.
So okay. Okay, I'll talk a bit to go through the effects of diversifying and what happens when you trade several strategies at the same time. In this case, we have an Excel file called the Portfolio Mixer, which you can find on the autostock.se website. And the benefits of this file, it's included all simulated results from all our trading strategies. And you can put together a portfolio of any strategies you want, and you can have a look at the statistical outcome when these are put together and as a portfolio, which enables you to adjust your performance according to risk and what kind of equities you want to trade. You may choose strategies that are multi-asset, or you may use several strategies for one asset or maybe two assets, and just check out how these perform together. So when you run several strategies simultaneously, you get some net positioning advantages, which are very useful when you trade mini futures. The largest one is actually you always pay the least possible interest rate cost. So you always have the smallest possible position in the market. So if one strategy goes long and another one goes short at the same time, they cancel each other out to some extent, which means you trade only the difference and also you just pay the difference interest rate. So this is an effective way of minimizing cost. Also, the effects of trading several strategies at one time, we can illustrate this quite easy. Here you see the bar light strategy, which we just talked about, and this is the only one selected at this point, and we end up with this kind of leverage. You have an return on investment of 292% during this time, and the maximum drawdown is 7%, which is quite low. But this is also the result of using a low leverage. We don't take any large risks normally. So and the leverage is defined by volatility, as we just walked through. What happens if you use the portfolio mixer? You can also see the result of risk-adjusted performance in terms of gain divided by pain. And the factor is the higher the better. You want as high a gain as possible divided by as low pain as possible. So in this case, we end up at around 2 in the gain pane for this simple strategy. If we select the Coda strategy instead, we shows a gain pane of 0.8, which is of course lower, but the return on investment is higher. Not much, but it's still higher, so 311%. And this illustrates clearly that if you look at the equity performance graph, you can see also that the maximum drawdown of this strategy is higher. It's 18% at the worst, which is around the end of 2015. You can see in this waterfall style chart. After that, it picks up again and produces steady profits. So what we want to do is find a combination of strategies that helps us maintain or even increase the return on investment at the same time as we want to push the maximum drawdown as low as possible. And this also helps increase the gain through pain factor. So check out what happens when we run both strategies simultaneously. As you can see, I've selected Barlight and Coda. And what happens in the portfolio mixer is that our money is divided equally on these two strategies. So we run 50% at each. And what happens with the performance is that we get the lower maximum drawdown of just 7% while keeping almost all of the return on investment at 309%. So we're back at around 2 in gain pane. Also, the chart looks much better. So this is just for 2 strategies, and I'm not going to babble along with a lot of more strategies. You can try this, download the file. It's available on the site for free, so you can download it and play around. There are several strategies here, so you can put together a very aggressive portfolio if you want to, and study what happens. Trading these strategies can, of course, be done manually. We use mini future for our positions. If you are not familiar with the concept of mini futures, you can find some educational information at our website. It's in Swedish, but it's no problem using Google Translate to have it presented in Danish or English or whatever. So I hope that can be useful. We try to simplify the content. Unfortunately, the banks that emit these mini futures tend to present the information in a very complicated way, unnecessarily complicated. So we tried our best to have it simplified. Also, you can find earlier webinars recorded on our website where we go through some of these leveraged instruments, mini futures and bull and bear certificates mostly. We do not use CFDs because Nordnet is not a CFD broker, and the platform we use if you want to trade these strategies automatically is the AutoTrader, which is our analysis and trading platform, exclusively connected to Nordnet. So you need a Nordnet account to use this one. And both of these 2 strategies are available as part of the free trading strategy pack in AutoTrader, along with a few more. Also, there are a bunch of paid strategies available for those who find a nice portfolio in the portfolio mixer and want to try trading, if you want to trade paid black box strategies, if you like. So we can help you set that up, and so you get going with that. But the free package is you can come a long way with those strategies, and most of them are available in with open source code to make you enable to change this yourself or modify the strategies, or if you do a simulation and you want to optimize some parameter or whatever, it's possible. Also, you can benefit from commission-free trading using the Nordnet markets mini futures. There is more info about that on the Nordnet website, of course. Basically, I don't know if there is the similar trading account style as in Sweden. We have the private investment account, which is tax-free, basically. There's no tax for profits, but there is a tax for an annual tax for the entire amount. But that is luckily very small. So I'm not sure if there is a similar thing in Denmark, but that's one of the benefits of trading mini futures. You can use this kind of account, at least in Sweden and Norway. More info at autostock.se. And as Robin told you earlier, we will email out this presentation as a PDF file, and if you want to go through some of it again. Also, we are of course available through our support email and phone support at between 10 and 12 each day. If you are interested in the Autotrader platform or anything else, I will be happy to help you. So basically that's what we had lined up for tonight. Do you have any questions?
Yeah, thank you very much for the presentation. Christian is wondering why the CODA strategy, why does it work so well in declining markets?
Well, that is a good question. We are not sure actually. We think that it has something to do with Mondays and Tuesdays being the early trading days of the week after a weekend, and possibly there are large movements from hedge funds or something like that, larger traders that want to. There tends to be an overreaction in the market at Mondays, particularly. So for some reason, it has turned out to be a very good day of entering the market.
Yeah.
Often closer to the end of the day seems to be better. I cannot explain exactly why this happens, but it's proved for several indices during decades of trading data. So and we usually not try to speculate in why something tends to happen, but it's more often a thing to try to make money from it,
yeah.
as long as it's still there.
Yeah, it makes sense. Tom is asking if you were to trade these strategies manually, what would be your tips?
You need to have a good chart service. I know that there are several ones out there in the market, but the thing is you need to see candlestick bars, at least for bar light strategy. The CODA strategy is even simpler. So basically you can have a look at any decent chart service, or even the Nordnet website will work.
Okay. Yeah.
So, but it might be tricky if you trade 8 or 10 different equities at the same time to keep everything in mind. At least the bar light strategy, you have to count the colors of the bars the 7 last trading days. So that might be a handful of work when you do it in real time.
Yeah.
So
So do you just trade automatically, or do you ever trade manually too?
Yeah, trade manually sometimes, but mostly for fun actually, or in research purposes. We try to constantly come up with new statistical edges, and as we run education since several years back, and this year last year we started the Infinity education, which basically we have done 52 edges, 53 ones so far the last year. So half of them are long edges, and the other half is short edges for the OMX market. So it's a constant development work, and sometimes it ends up with me or Henrik, my colleague, trading things manually to just try things out on the fly, not having to do the coding and simulate. If we find something that looks promising, we always code it and simulate it backwards with as large amount of data as possible to make sure it's robust. But sometimes we just trade for fun. If there is some time left between work hours, trading might be actually a way to rinse my brain from all the other stuff.
Yeah.
That's it's kind of a therapy.
Yeah. Mona is wondering, how do you come up with these strategies? Do you take existing and improve them, or do you build them from scratch?
It's a little bit of both, actually. We follow some Twitter accounts and websites, and read some books, and we know a couple of authors, and we had, for example, Larry Connors as a guest presenter at one of our own webinars a few years back, and we find inspiration everywhere. And whenever we come across something that looks interesting, we will try this out. And if it looks promising, we can try to develop it further ourselves. And other times we just often me and my colleague Henrik come up with some kind of idea, and we speak about it on the phone, and decide to try this and that, and usually it ends up in some kind of a statistical edge.
Yeah.
Not always, but I would say maybe 80% of, or even 90% of all the ideas we try fail, but the last 10% could show some statistical edge in the market, and then it's worth going forward with. But it's lots of work for nothing.
Yeah. And how can people contact you if they have any questions?
We're available at autostock.se. So that's the easiest way. Also, we are. You can find us at Facebook and Twitter. So it shouldn't be too hard. If you Google autostock.se, you will find us immediately.
Okay. Well,
So,
I think that's. Let's see here. I got a question from Sveinung. Which automatic trading system is the easiest to start with? Can we simulate historic data and test code changes?
Yes, you can. If I would say some of this CODA strategy is probably the easiest one to get started with, and Barlight is not much more complicated. So we have another one. It's called New York Bull, and there is a few stock strategies as well, easy to connect and get going with. So if you're interested and have any questions, you can always contact us, About simulation, if you opt for the standard AutoTrader base version, back simulation is not available. You need the Pro version to do that. And that is a one-time fee to upgrade your license to Pro. So in the long run, it's not more expensive, but there is a one-time fee for the upgrade. But then you have access to high resolution data, at least 10 years back for most equities, and for the Stockholm indices and stocks, most of them are since 2003. So you have a 1 minute resolution or better. All data from later than 2012 is second by second resolution, actually. So it's quite a large database.
Okay.
So it opens up quite a lot of opportunities if you're interested in coding, designing your own trading strategies, and checking out how they perform historically. There is some educations also available at the website if you want to learn how to code or how to design your strategies. There are educations available for that. Yeah, you're welcome to check it out.
Yeah. Well, I think that's it. No more questions. So I would like to thank you once again for a
Thank
great
you, and thank
presentation.
everybody who watched this tonight. Yeah.
Okay.
Okay.
Thank you very
Thank you.
much, and wish
Good
you all
night.
a good evening. Good night.
Yeah, everybody, have a good night.